one of the reasons why we settled on Caldera is like, number one, we just felt it was like the biggest, most ambitious vision. At that time, a lot of people were building like copy paste, DeFi protocols, etc.
What is it about the business that made you commit to it?
If it's successful, it means crypto has been remarkably successful.
Well, is there a book or podcast perhaps that you've listened to recently that materially changed the way you think about operating Caldera?
I have a metaphor I like to use, and I think it generally holds. And it's that Ethereum is America and Solana is Singapore.
Welcome to the Deco podcast, where we bring you stories from founders and investors in Web3. Before we get started, this is not a financial or legal advice. It's just a conversation about things we find interesting in Web3. Views expressed are our own personal opinions. Deco members or guests appearing on the show may have positions on assets they talk about.
All right. Welcome to yet another episode of the Deco podcast. We are doing something different today. I have my co-host Brandon from Layer 3, and we are thrilled to welcome Matt from Caldera. Let's begin with Brandon, and he will lay us the framework for this episode.
Awesome. Yeah, super excited to be here. So we, have Matt from Caldera. The goal for this conversation is really to discuss operating lessons behind building in crypto. We all, I think, have been inundated with podcasts that unpack the underlying businesses, but very few conversations talk about what that journey is like and operating lessons. And, I think there are some similarities and there are some differences relative to building in traditional early stage venture. And so that's going to be the goal of the conversation. But Matt, to jump around chronologically here, you obviously went to Stanford. And one of the things that is a seminal moment in any founder's career is that moment when they realize that they are able to start a business. And I think one of the benefits of being at a university like Stanford is that you're able to see people around you who have the same aptitude, start companies and raise. And so I'm curious, when in your journey as an undergrad, did that click when you were like, these people aren't any better than I am. They're not any smarter than I am. And I'm going to go raise capital and do this on my own.
Yeah, so you're totally right. Being at Stanford, you definitely get that sort of feeling. I don't think there was a single moment for me, but candidly, like you just kind of see it repeatedly. And I don't think this is necessarily a super healthy mindset to have, but like, you see someone raise a bunch of funds and you're like, oh, I was like 10x better than that person. Like what, in intro to CS, right? Like I don't really consider that person all that smart or like high aptitude. And then of course you have a bunch of other peers who you do look up to and respect, who are also raising money and also starting companies, et cetera. And I think, the culmination of kind of that feeling of like, oh, I can do better than some of these people, plus having like a peer group of other folks that you can kind of like lean on that you do respect to help with the founder journey. The combination of all those things makes it really, really easy coming out of Stanford to like kind of get the confidence to start your own thing. As well, should also mention just generally like the kind of capital availability there. Like it was especially true when my co-founder and I raised our first round back in like Q1 2022. So this was like back peak ZERP and then also, pre-Luna. So crypto was going crazy. Like, yeah, if you're like an undergrad, at Stanford, you're building in crypto and like, you're not completely stupid. Like at the time, people were like just throwing term sheets at you. And like, that's the experience we had. So you're almost kind of pushed into doing it. And candidly, I think at the margins, like at that time, less so now, maybe now with generative AI, like there are probably more people founding companies than there should have been out of the people I knew. So long-winded way of saying like, the environment is just very conducive to making that leap.
Well, take us back to that period of time, right? So 0% interest rates, a lot of innovation is kind of happening seemingly around pretty much every early stage venture market that exists, and it was amplified in crypto. You come to the conclusion that you want to start a business. What was it about the market that Caldera is playing in that gave you conviction that this was the market you wanted to start your first venture-backed business in?
Totally. So I've been in crypto on and off since I was like 12. So, funnily enough, and initially it did kind of come and go, with the price and the cycles, but like I had always found myself coming back to crypto. And part of that was just like an alignment with the values. And part of it was just an interest in the technology. When I came into Stanford, it was like 2019. So crypto was kind of at like a low point. And I candidly was not super into crypto. I thought that was like a phase, of my life that I had kind of passed me by. But then like when I came in, my like sub concentration was something called systems. And what you do in systems is operating systems, distributed systems, compilers, programming languages, et cetera. And I think if you're like working with, at the intersection of all of those things, you end up, finding yourself back in crypto And so very quickly, and I remember this moment, like my co-founder and I, we knew that we wanted to start a business together. We had a lot of respect for each other. We were brainstorming ideas. And at some point, again, this is now like late 2021, like I just got on a call with him and I'm like, I'm sorry, it's just non-negotiable for me. Like crypto is the most interesting thing to me. And so, he was slowly getting crypto pilled as well. But I was like, this isn't an ultimatum, but I'm going to be building in crypto. If we're building together, you also then need to be building crypto. And thankfully, again, he was interested in it as well. So that wasn't like too crazy of a decision to make. And then around that time, we then actually left school just to ideate and to validate ideas in the crypto space. And one of the reasons why we settled on Caldera is like, number one, we just felt it was like the biggest, most ambitious vision. At that time, a lot of people were building like copy paste DeFi protocols, et cetera. Like on our list of potential things to build, we had some things that I think would have been fairly innovative, but also I think would have kind of been much smaller opportunities and come to liquidity on a much shorter timeline. We realized what we wanted to do was launch something, big that could be very enduring, et cetera. And then another thing that I think was very important to us was to build an idea that we felt we were like fundamentally values aligned with how we wanted the space to go. So not necessarily what we kind of would have predicted the space were to go, where we didn't really have a lot of confidence in our predictive power, but like I wanted to build something where, if it's successful, it means crypto has been remarkably successful. And like, we're not betting on things like, regulatory capture, like crypto capping out at a certain, level of usage or activity. And I think a lot of businesses in this space actually do kind of like fit those themes. And we wanted to build something where it felt like we were kind of expanding the ecosystem rather than like betting on any one particular thing in the ecosystem, like kind of remaining constant. And so with that, like roll-ups for everyone, which at the time was like completely like heterodox idea, kind of became the thing that we ended up on.
And so fast forward to today, how many people work at Caldera?
Yeah, we're about 20.
20 now. So when you started, did you have any prior experience managing a team of 20 people?
So I had co-directed the hackathon on campus called Tree Hacks, which actually was a team of around 20 people, but 20 people working extremely kind of part-time. So in some sense, I had some experience there. Candidly, at the time, especially, I was a really terrible manager. So I learned a lot of like things probably not to do. But yeah, I hadn't had any kind of formal management experience.
So maybe, walk us through, you've kind of gone through this journey over the past 3 years, coming out of what was, sort of a very well-funded market environment into Terra Luna, into a very tumultuous bear market. You've had to navigate a lot as a founder. Maybe just tell us some of the operating lessons that you've learned growing the team from basically you and your co-founder to 20 people, and now one of the more dominant roll-up as a service providers in the market.
Yeah, a lot of lessons there. I think probably the most surprising things for me have been around talent. And I think that's a fairly typical thing for founders to say. Probably in general, like the most surprising thing was just the many kind of different ways people can work, like working styles, like how people think, how people collaborate, how people communicate. Biggest lesson was kind of learning to follow Pastel's law on that, which is like, kind of be like conservative in what you put out to the world and be pretty liberal in what you accept, i.e., just be fairly tolerant of people up to a certain point, because like people aren't always going to be able to communicate in the ways that you kind of expect them to, especially given like for most of my life, my immediate kind of friend group and collaborator group were all extremely highly quantitative people, all like engineers or similar. And so even just like interacting with like non-engineers, it's like a funny thing to say, but, like just kind of like being able to do all empathy there.
Yep.
I think like sort of like on the opposite side, I think being kind of like adopting like a sort of sports team mindset is really important. The kind of first experience letting someone go is never fun. You kind of learn a lot in those types of experiences, but we've kind of increasingly realized that we need to like kind of, treat the team like a high performance sports team. And that means being very direct with feedback, being very direct with communication, and like letting people go when things aren't working out. And so in general, like, again, every founder says this, but like, I wish I had let people go sooner and been more upfront with people. And now, at the size we are, like, I like to think we're a little bit more upfront and quick to action when those moments arise.
Yeah, I agree with that. I think that's a muscle that takes time to develop, particularly as a first-time founder, just because sometimes maybe you have too much empathy, or you convince yourself that the hire can work out, or that perhaps letting that person go is going to impact culture more than it really will.
Mm-hmm.
On the sports team point, I think one question that someone asked me recently is, what attribute is the throughput for all of the most successful hires? And what we found is filtering for highly competitive people. Either it's they love to win or they just hate losing, one of those two. But there's this sort of throughput that kind of connects their ability to just figure it out and want to win at all times. And then we've also hired some people who are very talented, but perhaps a little bit lower on the competitive spectrum. And that, tends to not necessarily work out. But I want to make sure that we, do unpack Caldera's business model itself for any of the listeners who perhaps are a little bit less familiar. So I'll pass it over to Saurabh to dig into the business itself.
Yeah, I mean, before we get into how it works and how it operates, I want to understand from you, like going back to Stanford, 0% interest rates. What is it about the business that made you commit to it?
Yeah, the biggest thing for us was we felt it was downstream of a lot of trends in the industry. We had gotten to understand the thesis behind modular blockchain, I think far earlier than almost anyone else. So we had, been somewhat into the Cosmos ecosystem that led us to Celestia. Back then, it wasn't even called Celestia. It was called Lazy Ledger. I think they had only raised their first round at that point. And then we also saw that rollups, we had seen kind of this idea of chains as a service, evolve. I think every cycle there have been people trying this, right? Whether it was Scale or Polkadot, and then the kind of enterprise blockchain trend. But we felt that with the invention of rollups, unlike with, proof of authority or proof of stake networks, which really aren't well suited to be running, to be offered as a cloud services, business model, rollups actually are just on a technical level. And so the combination of that plus our confidence in modular blockchains led us to think that the world that we currently live in, there was a good chance of it coming to fruition where, just people would want to launch chains as the kind of costs and ease went down. And so, we from that, again, it was a fairly conviction-based bet, but we had, I like to say almost tricked ourselves into believing that that future was inevitable.
Right. So with that, why don't you tell us about the business itself? I mean, right from what kind of services you offer to what kind of customers come to Caldera.
Totally. So we're most known as a rollups as a service provider that does what it says on the tin. People come to us when they want to launch a rollup or, just a blockchain of any sort. We help those teams kind of think through the different customizations they can make, stack choice, DA choice, sequencing choice, et cetera. And then we basically act as a cloud services provider to help them spin up those chains. So, good example recently was Ape Chain, the Bored Ape Yacht Club DAO. They came to us, they wanted to launch a chain for their community. We ended up helping them through deciding what stack to use, what configurations they wanted on the chain, help them loop in infrastructure providers, et cetera, and then ultimately spun up the chain and we're running the infrastructure. That means the sequencer, the RPCs, a block explorer, et cetera. So kind of minimum viable blockchains as a service.
Right. So next is, I want you to tell us about the pre-Caldera era and the post one, right? How difficult was it for anybody to launch a rollup or a chain before such a service existed? And what has changed since then? So maybe talk about two critical points. One is the demand for expertise that is needed to launch a chain, has that reduced after you launched? And also the impact on costs as well, right? It was expensive to launch chains, and I have seen various numbers being thrown around on Twitter. But if you can tell us what the number earlier was and ballpark how much it costs now.
Yeah. So I think before our category existed, the costs were legitimately in the many millions of dollars if you want to do this correctly. A lot of the kind of public solutions, they were being built not as infra providers, but as blockchains themselves. So, right, there's Cosmos SDK, which was very powerful, but was ultimately an SDK. You needed to hire teams to build the thing. And then you also need to incentivize validators to validate your network. There's Polkadot, which kind of had this sort of subnet model, right, where you're staking tokens to get a slot in the network.
Yeah, the parachain and relay chain and all of that. Yeah,
exactly. And but the cost for those loans, would be in the millions of dollars worth of token. And again, you still need to actually develop the thing under those models. And so only very recently has the cost for running a chain dropped. And I think we've dropped it by at least 2 orders of magnitude. Right now it's about, call it $100,000 a year or less. So it's less than the cost of a single engineer. And you get it kind of completely batteries included, right? You don't need to modify the execution layer or write any sort of sequencer level code unless you want to with a service like ours. You mentioned the kind of numbers that are being thrown around on Twitter. I actually think that's very interesting because, yeah, some people would still say, hey, it costs $10 million to launch a chain.
Yeah, that's the number I saw. Yeah.
Yeah. And those people aren't wrong. I think they come to that conclusion when like if you're basically trying to get the tier one infra providers at like every single layer of the stack, right? So you want Chainlink, and Pith, and you want Etherscan, and you want, right, like, continue that, right? Basically for everything. Like then you start to get into paying real money. And I actually think this is like one of the more kind of interesting things about how this industry has evolved, which is that like weirdly, like we've actually now lowered the actual cost to launch a chain so low that it's basically dwarfed by every other piece of infrastructure that you might want to have, right? Like, you can go to us or one of our competitors, launch the chain for like 50 grand to 100 grand a year. And some of those chains that do that, like they end up paying Chainlink 10x as much, just
Just for Oracle services.
yeah. Yeah. And so, ideally, like we want to lower the costs for everything. And I think that sort of creative destruction will happen. And it just so happens that, those cost reductions have happened first for the actual chains. And I think they'll come for everything else later.
Okay, so what is it that will make those costs reduce further?
Yeah.
I mean, it happened for chains. What's the plan for reducing it further?
Yeah. Our view on this is that, fundamentally, I think a lot of these business models of these like old incumbents now are very like outdated for the modular world. And we're already seeing more scrappy players kind of step in and provide similar services, sometimes even compatible services at like 1/10 of the cost. And a lot of that is just, the markets are getting more competitive for every type of service. And a lot of these newer teams are like, they're able to architect their service to use like fewer resources and be easier, to spin up on new chains in a more modular way. Because like we're kind of creating the demand now for there being like dozens of new EVM chains launched, every quarter, soon to probably be hundreds. Like people are adapting to that demand, and like the cost for every piece of infrastructure we're already seeing are going down.
Right. And like, what is the one or two factors that you attribute this cost reduction to? Because I'm assuming that when you are providing all these services, you are running either those nodes on your own or you are outsourcing that, right? So what has significantly changed, like one or two factors?
Do you mean on the like launching chain side or just other infra?
Actually, both.
Both?
Yeah.
I actually think the answer is sort of the same for both, maybe in just slightly different ways. And the biggest answer is just standardization. Because we work with like 3 major stacks, which means we can standardize a lot of our infrastructure setup for those stacks, which means, we're able to move again from like something that's more of like a sort of like consulting model, which a lot of people did in the past, or a model where you're basically putting out an SDK and forcing other people to like develop, their own thing and make it work and find people to run those nodes. Because we have like a, kind of minimum amount of standardization, we're able to like more easily launch new networks because they look very similar to the networks we've launched in the past. Actually, for kind of similar reasons, like we see the cost for other infrastructure going down as well. If you look at a team like Chainlink, they've launched on a bunch of EVM chains. And I think, and this is just my personal opinion, sort of informed by working with them and seeing other teams work with them. But like, they're very flexible because they've deployed on so many different EVM chains and they're all extremely heterogeneous. What we can do, because we're all fairly standard, right? Like we're running like 20 Arbitrum orbit chains. They all have more things in common than they are separately. Like it's easier for some infrastructure provider to spec that out and figure out a way to like support 20 of those chains rather than like needing to find a bespoke deal for each one. And so that's where we attribute most of the cost savings to for both ends as well. I just think the market has gotten a lot more competitive, more teams fighting for market share, and that tends to drive costs down as well.
And in general, in any crypto sector, like we've seen power laws at work, right? Whether it is even with memes, right? Top 2, 3 are the ones that capture most of the value, and then there is long tail that has like probably 10 to 15% of value. With only a handful players in roll-ups as a service sector, in the category, how do you think of the pricing power of these players? And like, let's say that you achieve a critical mass of customers. Are there levers that you can use to jack up the profitability so that, like perennial question where we always say that crypto companies are not profitable, but like, are there levers and like, what are those for you guys?
Yeah. So I think what we've seen is that pricing power actually for like the better providers is only going to go up over time. And I think this was like fairly unintuitive, even for us when we started. But like there are real network effects around trust. It's sort of like the old adage, like, no one got fired for buying IBM. Now that might be less true. But, no one's gotten in trouble for choosing Caldera, as your roll up as a service provider. You might, and we've heard stories from other providers where, that might have caused you issues. And so I think like the best providers in the space, as we attract more value, as we prove ourselves in the market, we're going to have our pricing power only increase. I think for us strategically as a company, we don't want to be too extractive on the project side, candidly, because we think there's a lot more money to be made in terms of helping users move money around and move value around and communicate across chains. And that's also, we're a little bit kind of more aligned with our customers, right? So, what I'm getting at is sort of, we're working on kind of like interop related things right now, as well as just like liquidity kind of onboarding solutions. And, making money on that end, first of all, we found generally it's a lot easier to do. When we work with interop providers, we find, generally actually they're making, oftentimes more money off of the chains we run and the integrations we do than we are. And also it's just very aligned. Like these chains, they want funds on their chain. They want value. They want more users. If we can help those chains achieve those goals, like, they're a lot more okay with us charging on like a per user basis or some percentage model than what we have right now, which is a fairly kind of flat cost structure, because candidly, like the cost for running a chain that secures $500 million of value is not all that different from a chain that has very little value or activity on it. And so pricing, as like a pure kind of cloud SaaS play where we're only making money from the projects we serve will get kind of difficult unless we explore these other avenues.
So in terms of growth, right? I mean, I was looking at the kind of VMs or execution networks you guys provide, and I saw Arbitrum, OP Stack, and ZK, right? So where does the growth come from? Like, do you think of like entering into other sorts of VMs, other TA services, or like a completely different ecosystems like Solana, perhaps?
Yeah. So we kind of view each ecosystem as kind of like its own like country, right, or state. And so in the past, we've found like a lot of success from this sort of like land and expand sort of strategy where we aim to be a fast mover in the stacks that we are really confident will succeed, make ourselves like the kind of trusted player in that space, and then grow with that ecosystem. We'll continue to do that for stacks that we think have a lot of potential. That definitely might include multi VM or all VMs. I'm very close with a team called Soon, which is working on like a Solana VM implementation on top of Ethereum. I follow like the kind of mixed or blended VM environment very closely as well. And so definitely when we feel the time is right, we'll integrate those stacks. That said, our focus has shifted a little bit now where, there are real trade-offs when you're between spending the engineering effort to integrate new stacks versus improving the product in a way that improves the experience for everybody. We're more leaning towards the latter right now, especially because we've got great market share on the top stacks that we serve already. So the calculus has changed a little bit for us, but like strategically, we kind of think about these things like the same way we always have. And, it's almost a certainty that we do continually add new stacks, constantly. In the same way, I think a cloud provider will always like entertain the idea of supporting new operating systems as they come out.
What are the expenses or difficulties in, let's say, adding a new service? Whether it is, I mean, for example, if you have Celestia and you want to do EigenDA as well, what kind of an effort is it? And similarly, you have like ZK Sync right now. So pretty sure like you have prover mechanisms and all of those things sorted. But what if you want to offer something like a Starknet? Like, how does that change things for you?
Yeah, a lot of it is just upfront engineering cost. And then there's definitely, an engineering cost to like maintain the solution and keep it up to date. For this reason, it's the kind of way to model the cost is like, it's a pretty big upfront investment to, have the capability to run a new stack on mainnet in a production setting. And then once you have that, right, there's very little difference between doing 10 chains and doing like one chain. And so for us, like we need to be fairly opinionated on like the bets we make in terms of integrating new stacks. Every stack is different. There's a significant amount of effort to support a new one. Like a lot of it is just like fitting that stack into our existing infrastructure and, sort of just like gluing things together on the back end. And then as well, like the maintenance costs are like non-negligible. One thing that everyone likes is like we provide a managed service. We keep people up to date when they want to be up to date. If there are security upgrades that, are urgent that we get notified of from like the stacks themselves, like we'll prio those upgrades. So our customers don't need to worry about these sorts of things, but it means like we are the ones who need to worry about it. And so again, like every new stack is kind of more surface area for like those things to happen and more attention that gets diverted away from other things.
Well, I mean, maybe before we switch back to operating lessons, let's just zoom out for a second. Fast forward 10 years, it's 2034. Assume everything worked out. You executed perfectly. The market goes exactly where you expect it to. Describe to us what Caldera's business looks like in 10 years.
Yeah. I think the biggest thing is that a majority of transaction activity is occurring on Caldera infrastructure, right? What that probably means in practice, ideally, we see mainstream adoption of blockchains for the use cases that blockchains are very good at. Ideally, maybe Visa is running a payment network on a bunch of Caldera chains, right? And that's all happening on our infrastructure. That's what we view as kind of like the ideal. It's always been our goal to kind of be the biggest creator of like net new block space in the blockchain world. I think we're actually very close to that already. But then, ideally, more and more demand for block space exists. On the business side, what this means is like, I think it's a fairly skeuomorphic to cloud services right now, with maybe a little bit more focus on kind of like payments and like liquidity solutions rather than just like pure compute and networking. But really, like, we want to be kind of the entry point for everybody, for users to onboard liquidity onto these chains, for these chains to connect with third-party infrastructure providers, sort of in like a marketplace-based model. So like, kind of like ideally, we're as helpful as we can to as many people as we can be, in across like all of those different avenues. Again, not a super specific answer, but candidly, that's kind of the position we've already found ourselves in. Like, we're involved with infrastructure selection, bridging, et cetera. And so it really is just kind of like expanding all of those areas.
Let's switch gears and talk about financing. So you're a first-time founder, you're going out to market, you're raising capital from venture investors. Can you maybe just walk us through your financing history and then some of the lessons learned along the way? Anything that you think you would have done differently, and then some of the stuff that, you got right and that you're really happy about with respect to just raising capital?
Yeah. So we've raised 3 rounds. The first, the one I mentioned that occurred during ZERP, that was our pre-seed. That was led by Sequoia with participation from a couple other people. We kept that one pretty small. Then we raised a round. It was kind of an interesting situation. Term sheet we signed, like, I think we received the term sheet the day before FTX imploded. We signed the term sheet the day after, and that was done by Dragonfly, and much to their credit, they honored that. And then we kind of filled out the rest of that round after FTX. So it was kind of halfway raising in the bull, halfway in the bear. And then most recently, we raised a Series A from Founders Fund earlier this year in July. In terms of lessons, I think the biggest thing that I've taken away, and this is like a quote I've kind of shamelessly stolen from one of our earliest investors, Ali Partovi, who is not in Web3, but has been very prolific in the Valley for quite some time. He says like fundraising is about search, not persuasion. And that really stuck with me. It's kind of very similar to dating, I think, where, the kind of like folk model of fundraising is like investors are very convincible, sort of like Shark Tank. You go on, you like put on a show, and like if your show is like good enough, right, like they'll invest. What we found generally is that is not the case. There will be many investors that just don't agree with the thesis. There are many investors that, will believe that like you as a founder, your profile is not the right fit for the type of company. And then conversely, there are like investors who will instantly get the thesis and like are instantly drawn to you as a founder. And I think the kind of healthy way to approach it is to recognize that, you're kind of looking for the investors in the latter camp rather than trying to convert investors from the former camp to the latter camp. So that was like kind of the most helpful thing. Again, I think a lot of it is, just kind of managing the emotions with fundraising. It's always very difficult. And like, it's one of the few things I think in running a company where the progress is very non-linear, which at least for me makes it, somewhat difficult to deal with, at least more so than like engineering or product dev. And then to your second question about what we would have done differently, I think generally we've approached raising by developing really deep connections with VCs we really respected. And that's candidly made getting term sheets easier because we already have people in our corner who kind of want to invest. And so when we end up actually formally opening up a round, we kind of have people warm. I think probably the smarter thing to do would have been to do that, but either have more investors in that camp where we could run more competitive processes, or just kind of choose to run more competitive processes, i.e. like not fall in love with investors, before we've run a competitive process. And so my thinking is we probably have left a little bit of value on the table, because we've kind of committed earlier. We don't really regret it, but, if I were to change something about how we raise, that's probably what I would change.
And now that you've raised 3 rounds and you've built what is objectively an incredible cap table, What have you learned about getting the most from your investors? And feel free to be as detailed as you'd like, be it communication style, how you go about asking them for things. But if a Stanford undergrad were to come to you and say, I just raised this round, I've got Sequoia, Founders Fund, Dragonfly, and a handful of really great investors, how do I get the most out of them? What would your answer be?
Yeah, I think the most important thing is to, again, tailor kind of communication to their specific investors. I also just generally making it easy for them to help, and candidly, I don't necessarily know if I'm do the best job at this all the time, but I think when I really want to help, I do, right? But like being very specific with asks, making sure you're asking the right people for the right things. My kind of mental model for VCs are that like they're very busy, but they're kind of professional networkers. And so like asking them for things that are very easy, i.e. like intros to people they already know is, generally much more fruitful than asking them to do something very difficult and time consuming. So I think just kind of being realistic and targeted with the asks is very helpful. And then I think outside of that, like I think just keeping folks in the loop and kind of wanting to help is useful, like just kind of increasing the surface area, making sure investors know what you're up to. And so if they want to help and they have the time, they're able to, is always helpful. And then, yeah, outside of that, I think this is like less tactical, but I think early on when we were young, like we kind of probably expected too much out of our investors. Like we expected them to be difference makers. I mean, as you mentioned, right, we were able to get some really kind of prestigious VCs in the cap table. And what I found generally is like, I've never been able to rely on investors for like kind of like pounding the pavement generally, with some exceptions. But like, asking an investor to like work through their network to like get some intro has like some probability of success, but it's not, anywhere near 100. But like the great investors, they prove their greatness in like really hard times. And so I think just adjusting my mental model to like valuing investors, like how they'll be kind of when times are bad or when there's a tough decision to be made versus like what they'll do when everything is generally working out has just been helpful, again, just to conceive of, of investors and, our relationship to them. Thankfully, we've never had any major problems with investors, but this is one of the reasons why we really wanted to work with Founders Fund in our latest round, because like they, philosophically, we knew that they weren't going to try to impede on the business in ways that we didn't want them to. And again, we've been super fortunate. Sean at Sequoia and Ani at Dragonfly, all of our lead investors have been like very, very, I think, deferential to us as founders when they needed to be, and very, very helpful and able to give like strong advice and feedback when we wanted them to. And so no complaints at all. But generally, I think as a founder, like that's kind of all you can ask for. And, it's worked out so far.
Yeah, I think that's one of the things if you're a founder to reference for is just how the investor manages perhaps when the business is going sideways or not necessarily performing well. Because, it is in many respects, most venture investments are supposed to be 10-year buy and holds. And so having someone who has the conviction to endure periods of time where there's turbulence is really important. Switching to co-founder dynamics, a lot of operators or founders in the industry obviously start their business with the co-founder. So I think it'd be interesting to unpack how you and your co-founder, Matt, it sounds like you guys knew each other from Stanford, and then how you go about dividing responsibilities.
So yeah, we met first day of college. So we've been working on stuff together, for years prior to founding the company. In terms of division of responsibilities, there are some things that we decided were very clear cut in terms of who were the final decision makers. Like, I'm the CEO, so a lot of the go-to-market stuff, including building out like that side of the team, was under my purview. And, fortunately, generally, like my co-founder Parker is not like he's interested in that sort of things and he can be opinionated when he needs to be, but he's not really interested in kind of, being very heavy-handed there. And then conversely, like he manages a lot of the engineering. We do share product as kind of a focus. And I think that works out well for us because we're able to, come to agreement most of the times, and I think disagree very constructively when we do disagree. But again, like this is something where I would struggle to give like generic advice, candidly, just because people are very different. What I have told people is like, just make sure that the priorities and the values are fairly well aligned. This is actually the bigger thing I saw with a lot of friends who are starting early stage companies is like, it's not uncommon for someone to say, well, if we got like a $5 million acquisition offer, all cash, I would definitely take it. And another person say, look, I want to build this business, right, to be a unicorn. That is extremely destructive to have. And thankfully, we have never, ever had a disagreement about like where we wanted to take the business. And I think like that's been enough of a foundation for us to like build a really good working relationship off of.
Maybe to go one level deeper, I think it's obviously human nature to disagree. And in many respects, it's a positive, particularly when building a business, to have two people that have different points of view. So how do you two handle it? If, let's say, you're making a core product decision in opposite sides of the coin, typically, how does that manifest, and how do you guys come to a resolution?
Yeah, this is like one of those things that I think the earlier stage you are, the more of these types of disagreements you have, just because you have far less data. I think very early on, we fought about a lot of product decisions, and now we rarely do because the data is fairly clear on what to do, or at least like the kind of set of rationalizable decisions is very clear. I think generally our style is literally like we can just hash it out. Sometimes it takes a lot of time. I think we're able to come to conversations with a very like kind of intellectually honest approach, and like generally we can come to some conclusion after enough discussion and enough kind of pulling on the data and like investigating various threads. It's really rare that we have deadlock at this point in time. If we do, I think we've like learned to just kind of disagree and commit. Generally, like we'll defer to whoever feels stronger. That's worked out well, and that only works well if people are willing to be honest about the kind of confidence interval they have on their opinions. And if you have enough trust in the other person's judgment that, you feel like they're making good decisions most of the time. But we're at that point. And so we haven't really had to deal with like major, major issues on this front for quite some time. I will say at the early days, like I think we weren't as well practiced on this and we did make some fairly bad decisions.
Yeah, I think that's inevitable though, right? It's sort of the Brian Armstrong kind of quote, which is action produces information, I think really matters when you're starting a business. It's just move, make decisions, and then figure out, the feedback and try and make that as fast as possible. One of the things that I found just in kind of my journey and chatting with other founders that I respect is that the best tend to be students of business history. And they tend to sort of have this like mental model or mental board of founders that they really respect. And so I'm curious, during your journey, are there any founders who you really admire and you kind of try to emulate their decision-making framework in moments of ambiguity, or founders that you try to aspire to be like?
That's a good question. Candidly, I've always done better thinking about kind of specific anecdotes that are most relevant and applying them to the situations that we're in. I don't think like I am not really someone who kind of idolizes any like, particular person. But yeah, that said, like I consume like a lot of, content around business. And so like, when there are kind of things, that closely kind of resemble, other things that, we've seen, I think I generally try to bring them up. I am blanking a little bit on specific examples. I wish I could give one.
Well, is there a book or podcast perhaps that you've listened to recently that materially changed the way you think about operating Caldera?
Yeah, I've been really consuming like the Acquired podcast recently. That has been very interesting. Another sort of side of business that I've been going deeper into is actually running sports teams, which I think is very interesting and actually somewhat relevant because they're just kind of these entities that spend a lot of money to try to make a lot of money. And I think, a lot of crypto companies do similar things. And so honestly, just like even going deeper into like the Dodgers, like merchandising strategy, I think actually has some relevance to like incentivization strategies for like app chains if you kind of, if you squint and maybe stretch a little bit. And so I think like, yeah, finding these analogies are very helpful, as well. There's kind of the general kind of startup canon, right? Like 0 to 1, the hard thing about hard things, that, as well as like probably my favorite quote unquote business book. And there's just like a lot of lessons and anecdotes from there that we take and we try to apply to our business.
Because I'm curious, let's go maybe one level deeper on how the Dodgers merchandising strategy relates to app chains. Maybe just 60 seconds. I'm curious. Yeah. What are the connections there?
Yeah, it's a little bit of a stretch, candidly. I waffle back and forth on this. I think one of the more interesting things that we're seeing in the kind of roll-up space is very different philosophies around incentivization, right? Like OP has very famously gone quite hard with, incentivizing new chains and giving out grants. And I think one of the things that allows them to do that is they've really figured out ways to immediately drive revenue from those chains via their like super chain sequencer revenue share. And my guess is via their interop model, they're also going to, to be able to make some money. And so how this relates back to the Dodgers, I guess, is that, one of the reasons why they've been able to build such an amazing team with a lot of talent is they fundamentally are able to monetize that talent better than anyone else. They have like one of the biggest audiences. They're actually very close. Like being on the West Coast, i.e. having Japan as a viewership market allows you to actually do better, both in terms of merchandising and advertising and sponsorships, et cetera. And so there were some parallels there that I shared with my team. basically, again, it's nothing too crazy, right? But like your ability to kind of monetize these like individual chains, directly leads to our ability to like incentivize them and our, ability to be competitive in the market if we do want to go down the path of incentivizing chains. Again, a little bit of a stretch. I was like watching some YouTube videos late at night and sent this to my team. And in the morning after I woke up, watched them again. And it's like, this is relevant, but not completely. But, just generally like trying to take those lessons and applying them, is always fun.
Yeah, not as much of a stretch as I think you think it is. Sometimes navigating the idea maze is best done by taking a business that's not in the market that you're playing in and understanding how they do it and then figuring out how that relates. Switching gears before we wrap up to just the operating rhythm with which you guys run Caldera, maybe talk to us a little bit about how you get things done within the business. So how are your product cycles structured? Feel free to be as detailed as you'd like. So, how do you guys manage individual issues? Who's overseeing that? How frequent are you guys touching base? Is the team remote or in person? Just talk about how you guys manage the company today.
Yeah. So the way the team looks right now is we're hybrid, which effectively means we're remote. Pretty big contingent of the engineering and product team. And of course, myself and my co-founder are based in SF. So we do have some kind of in-person energy, which I think is important. But in terms of the way we run the company and communications, et cetera, it pretty closely approximates remote first, remote company. In terms of product cycles and just building stuff, what we've found is the best way to do that is to kind of, atomize and divide things to be as sort of like self-contained as possible. And then assign those things to ideally like one person or like a very small set of people who have like full responsibility for getting that thing done. And so we're able to kind of run a fairly, like we're a very high trust team. It's also, this model kind of requires everyone to be quite good, because for any given project, there's usually only like one or two people on it. And they're given a lot of trust and ability to like, design and iterate and like make kind of snap decisions. We do kind of weekly sprint planning cadence. Like, I don't think doing bi-weekly would change things too much. I think it's just nice to have weekly touch points at the margins. I think it helps people get things done faster. But yeah, I think like generally, trying to be good at holding ourselves accountable to hit deadlines and not having diffusion of responsibility is like our MO internally. As well, one other thing I guess I'll mention, because it's very core to us, is like we have everybody involved with the support process, especially all engineers, but myself and like our BD guy and everyone else, like we're all very active in supporting the product. And that's very intentional from our end as well. It's something that everyone highlights when they give endorsements to us or they mention how much they like working with us. Like we view support as like number one prio. And again, just having everybody involved in those conversations allows us to kind of float issues to the rest of the team and kind of develop that product empathy much faster than we would otherwise. That's probably kind of the most, I don't even think, it's not like unorthodox especially for like a technology or Silicon Valley company, but it's probably the more polarizing thing, on the team. Like people have said like, hey, I think we really need to hire someone dedicated for support. And I'm fairly dogmatic about not doing that, at least at this point in time, or at least not doing that for actually performing support for the reasons I mentioned, empathy, et cetera. And also just like, it's a complicated product. I get very frustrated as an engineer when I, hit support and it's very clear that support doesn't understand the product. And for something as critical as what we're doing, I think it's important that like we have our best people always, supporting the product.
Yeah, support in our industry is criminally poor. So I think, and having worked with you guys, I think you guys offer a great level of support. Last question from me, but when you look back on the past 3 years of building the business, what is the moment in which you're most proud? Or maybe over the arc of the business, what are you most proud of from Caldera?
Yeah, I guess I'll talk about something that I really rarely talk about. It's kind of surviving direct competition from our competitors. So very kind of early on, before there was really any market for what we're building, Paradigm launched a competitor to us. It's actually, Matt Huang's brother that founded the company, right? So very, very insider company. And obviously he's a very strong engineer and I presume like a strong founder, at least in some respects. And, they were very, very aggressive in trying to take market share from us, as they should be. And I think for us, like that forced us to adapt very, very quickly to like kind of try to find new markets, new ways to position the product very quickly. And, it was not a fun kind of early introduction to business, right? Like I think typically a lot of startups, you're going after like larger incumbents. It's sort of PvP, but only in one direction, for some time while you're getting your footing. But for us, it was always like, extremely, extremely highly PvP. Every deal we do, we're head-to-head sales against at least 2 other fairly solid companies. Right now, Gelato is under the space, Alchemy is under the space, etc. And so, like, just being able to, like, be one of the top companies in this space when we're against such formidable opponents, that's what, what we're most proud of. And then I think the kind of corollary to that is like, we're proud of it, but it highlights a need to stay very vigilant and very paranoid. New entrants are coming to the space in general. Like, a lot of people have the explicit MO to try to put us out of business. That's kind of a fun position to be in. And it means survival is something to be very proud of. But, also it's not a fun place to be some of the time.
Not fun, but it forces performance, which I think is really important. Well, Matt, this has been awesome. I really appreciate the time. Saurabh, I'll pass it over to you for any closing questions or remarks.
You said that you keep observing the market, you keep observing how rollups go to market and so on. And now that Solana has started performing better than Ethereum on several metrics, do you think that Ethereum changes their roadmap and kind of moves away from the rollup centric roadmap and tries to enshrine a certain things? And if that happens, how does that affect Caldera?
Yeah, I have a metaphor I like to use for this, and I think it generally holds. And it's that Ethereum is America and Solana is Singapore. Solana is very top down, performance driven, they are more kind of centralized in terms of decision making. So they're able to make these, build like a great blockchain with all this, cool parallelization, et cetera. I don't really view like Ethereum's roadmap as a potential threat, and I don't think they're really going to be able to go down that direction, or do they want to? Because fundamentally, they're optimizing for something else, which is a little bit more conservatism in how they design the protocol. And, there's like a little bit of rollup FUD, I think, with the recent announcements, but I really just don't think that like the recent announcements, like they're not bearish, on what we're doing. Like, we think there will always be people that want to launch chains. They're always going to want to do it on like the most credibly neutral settlement layer. Ethereum is, going to remain that forever because no one else is actually optimizing for that. And, and this goes back to the metaphor, like the kind of way that Ethereum has always worked is that like they kind of let other people do the innovation and like run experiments. It's a little bit more of like a, American model where you push some things to the States. And, to complete that metaphor, right? Like a lot of the actual most interesting protocol development that's happening at the layer 2 and layer 3 level, that's not going to change. Fundamentally, I just don't think the EF is like set up to turn Ethereum into Solana. And I don't think they want to be. And so we just think like the kind of horizontal scaling roll-up centric feature is kind of the one that we've all committed to, at least in the EVM world. And I think it's very, very unlikely that that changes. So yeah, we don't really see any of this sort of stuff as a threat. There are good opportunities because I think the EF does realize that this is the place for Ethereum. So this notion of like enshrining rollups, et cetera, like providing, snark validation capabilities at the base layer, like those are all really exciting things for rollups. And, once those things are ready, which sounds like a multi-year timeline, we'll be excited to support them.
All right, Matt, thanks a lot for spending time with us.
Yeah, thanks for having me on.